Well, good afternoon from here in London, and good morning from Massachusetts, where we have our guest, Tom Levenson. Tom is a well-known professor of science writing and an author based at the Massachusetts Institute of Technology, MIT, just down the road from a far more important university called Harvard. And it's really a delight to have
North.
Tom here. uh, because I actually read his book and I thought, this is a guy we've got to absolutely have on this program. But Tom will be explaining that. Now, you'll all know me. I'm Michael Minelli. I'm one of the directors of Zien, and it truly is my privilege to be able to introduce many of these FS Club webinars. And I say a privilege because I get to meet great authors whom I admire, like Tom, and get to chat with them about their books, amongst other things. But I can only do that because our sponsors allow us to range widely and freely across technology, economics, and finance. And there may not be too much technology here, but there's a heck of a lot of economics and finance as we cover the Saucy Bubble. This is circa 1720. And in our little warm-up chat in the kind of green room that we have behind the scenes, Tom was remarking upon the remarkable presence of Walpole in all of this as the first prime minister, effectively, of England. So we've got a lot of ground to cover. My job is to get out of the way and let you hear from the great man himself. That's not Walpole, that's Tom, by the way. And we're going to be covering a fair bit. There's a Q&A facility in the GoToWebinar session, and I will feed your questions, observations, and comments into a discussion with Tom. Please do use that facility because I'm here with you, so I won't be getting your texts or emails until they're far too late. By way of two fairly obvious questions, yes, the slides will be up and available. And secondly, the recording will also be available for your friends and colleagues in approximately 2 days. Now, just before we get cracking, Tom wanted me to ask you a question, the first of 3 polls today, and basically, are you smarter than Isaac Newton? So fingers on the buzzers, please. The poll is being distributed. If you just click, basically, yes, of course I am. No, he was the greatest thinker of all time, maybe. And I'm just not smarter than him in mathematics. So here we go. We've got some very confident people out there. Over half the audience has voted. I'll leave it open just a few more seconds as the numbers creep up to the 3/4 mark. Over 3/4 of the audience has voted. Another couple of seconds for those of you who are still so slow you're not smarter than Isaac. And here we go. I'm going to close and share those results with you. And as you can see, about a third of the audience boxes him into mathematics. About a third says, no, he's smarter. And I must say, an interesting bit is a third are still unsure. So there we go. Kind of interesting. Anyway, over to you, Tom. You've got a daring audience out there who think that they're darn shrewd.
Okay, thank you, Michael, for that kind introduction. And I'm impressed that 3% are convinced they're smarter than Isaac Newton. I'm not sure whether that's encouraging or terrifying. Okay, so today we're going to talk about one of the first great examples of a crisis driven by the hunger for money for nothing. Next slide, please. Not this one. There we go, that one. Not this one, but I admit that Mark Knopfler's song did inspire the title of my book and this talk. Next slide, please. Instead, let's turn to an event that occurred 300 years ago, the Saucy Bubble, which in popular memory is often framed as Alexander Pope does here, as perhaps the original sin of capitalism. That was what Pope genuinely believed, by the way. So I'm going to argue, I'm not going to deny the fact that the Saucy Bubble was an amazing mania, but I am going to argue that for all the folly that genuinely existed, the bubble should be understood as an event that reveals both the power and the structural vulnerabilities that changing ideas about money always bring, and the ones that we still grapple with today. So let's begin with a seemingly remote story, how the scientific revolution helped create a parallel revolution in money. This looks like an ordinary map. It is, in fact, a powerful tool of colonial rule, constructed out of the ideas of the scientific revolution. Such maps were part of the Down Survey of Ireland, led by William Petty in the early 1650s. Petty created rigorous and standardized tools of measurement to do the survey for this map, and he had a quantitative approach to set the price for each acre of Ireland. It was the key step in confiscating Irish-owned land to give to English soldiers and to City of London investors who had backed Cromwell's invasion in exchange for that captured property. Next slide, please. What was revolutionary about all this is that, you have to understand Petty's role. Petty would go on to help found the Royal Society. He was one of the original 13 or 14 members. And his commitment to empirical measurement, in that you see in that quote, and observation, formed one pillar of Britain's version of the scientific revolution. And number two, there's the other. When Newton talks about reasoning nimbly about figure, form, and motion, he's talking about creating a mathematical account of physics. Next slide, please. Which, as he very well known, this is, by the way, the portrait of the youngest portrait of Newton there is. It's after this period, unfortunately, 1689, but it's as close as I could get. So Newton knew that the mathematics he was creating to express physical ideas encompassed journeys through space and or time of much else besides the apple or a planet or the moon. Next slide, please. Here's an early example of Newton's fascination with number and the concept of a calculation evolving through a series of steps. This is from an early notebook from the time he was working on what would become the calculus, or the mathematics of change over time. And crucially, as Newton himself would recognize, this could address such mundane matters as the present value of the rents on land owned by his own college, Trinity College of Cambridge, or the appropriate rate of interest to, in his words, quote, get the poor in work. Next slide, please. Newton's forays into the mathematics of economic life weren't the only or most important extensions of the scientific revolution into the analysis of human problems, however. This, for example, is Edmund Comet Halley's famous life table, a tabulation of the population of Breslau, now Wrocław in Poland, by their ages. With this data, Halley performed a series of calculations, in part to discover the proper pricing for annuities for each age cohort. This study was published in 1693, and it is, in fact, the foundational paper on the mathematics of life insurance. Next slide, please. This is the scientific revolution come to Lombard Street. Okay, and with that, let's shift our focus a little bit to Exchange Alley and lead up to the events of 1720 and the Saucy Bubble itself. Exchange Alley, you'll see in this map, it runs in sort of twists and turns between Cornhill, right at the opening is right across the street from the Royal Exchange, and it's still there, and it runs down to Lombard Street, and it is now just a horrible blank, post World War II bombing kind of nothing destination. But in the 1690s, Change Alley had become the main locus of London's nascent market in money, as licensed brokers and unlicensed jobbers and market touts and hangers-on of all sorts gathered in its coffee houses, corners, and side passages. If you look kind of in the middle, it's tough to read, I understand, but there's the various places that were famous then are marked on this map, and the posher folks tended to trade at Garraway's, but Jonathan's, up at the Cornhill end of the alley, was where much of the action took place. Next slide, please. There's nothing left of Jonathan's today, as I say. The alley has been transformed. But there's an oval blue marker, one of those historical markers on a blank white wall. But Jonathan's is usually considered to be the first location of the London Stock Exchange, and it's shown here in a rather uncomplimentary mid-18th century cartoon. I know the caption is basically unreadable, but you can get the tone of the author's view of the morals and ethics of stock trading from the three pictures up on the far wall in the room. There's the devil watching a fat duck who's about to get plucked by the foxes on the left. So what was bought and sold there? Can I have the next slide, please? Well, shares were, there were a handful of large joint stock companies, and their shares were traded. That would, most important of them would have been the East India Company and the Bank of England, founded in 1694, I believe. And there were some others, the Hudson Company and the Royal Africa Company and others. And in the 1690s, there was also a boom in projects, new businesses organized in joint stock form that ranged from serious companies to scams, both of which were routinely traded along the alley. But as much as anything else, Change Alley dealt in government paper, of which there was, beginning in 1693, as you see in this slide, an ever-growing supply. This slide lists the long-term borrowings, most of them irredeemable, floated in the first 5 years of something truly new. loans sought by Parliament and not by the notional person of the monarch. That is, that first £1,000,000 of borrowing authorized by an Act of Parliament in 1693 marks the creation of the first British truly national debt, one for which the government of England as a whole, and not only the king and his personal resources, accepted responsibility. The total borrowed in those 5 years was unprecedented. It's hard to make a meaningful conversion into 21st century terms, but one way of getting a sense of the scale of this national borrowing is that it was almost exactly the same amount as all of England's hard money supply, the £6.9 million and change in silver coins that the recently appointed Warden of the Mint, one Isaac Newton, produced at the Tower of London during the Great Recoinage of 1696 to 99. And that big scale prompts an obvious question, I think. What was all that money for? And the answer, I'm afraid, will be all too familiar. Wars that the nation otherwise could not afford. The end of the Stuart dynasty and the Glorious Revolution in 1688 marked the start of what turned out to be a long century of war, but mostly with France, though some other opponents showed up from time to time. And these were a series of conflicts that would ultimately span the globe in the contest for European and world preeminence. Next slide, please. Such wars would grow ever more expensive, and in that context, the invention of a debt guaranteed by an institution rather than a person proved to be a vital instrument of British statecraft, which is what Daniel Defoe is boasting about here. No superiority in the field, our superiority of treasure. But Defoe is wrong in this quote about one thing. Even with the advantages of this new form of borrowing, Britain's storehouse of money was not limitless. Next slide, please. All you need from this slide is that the 9 Years' War turns out to have been a bargain. By 1720, the various conflicts and other government operations had turned that £7 million first sort of wave of debt into almost 50 million. Next slide, please. The numbers here pretty much speak for themselves, I think. In peacetime, it took 1/3 or more of annual revenue, the nation's annual revenue, to cover its debt service. At the height of military operations, when some conflict was running at full bore, that debt service could lead to 2 or past 2/3 of the nation's takings. Making matters worse, as the Treasury often in desperation experimented with various ways to raise cash, it created a wild variety of ad hoc approaches: lottery loans, annuities, extended term obligations, some for as long as 100 years. And because they were borrowing at points of crisis, often the interest rates ranged from 6%, which was right around the maximum chargeable in private loans at the time, all the way up to 14%, which was just truly onerous. And perhaps worst, 2/3 or more of that debt was irredeemable. Even if it had the money, the Treasury couldn't redeem it, couldn't retire it. And that's where the South Sea Company comes in. Next slide, please. South Sea Company had been founded in 1711 with a schizophrenic mission. It was to have a monopoly to trade goods and slaves with Spanish America. The asiento was the contract for the slaving side of the business. And for those privileges, they were to manage some of the accumulating body of debt, including some of the floating debt, which is another problem that was tangential. Well, not tangential. It was involved in the bubble, though the long-term debt was the key to it. And through 16, for those purposes, so they were to manage some of the accumulating body of the debt, and they were to lend to the Treasury as needed. Through 1719, the trading side was at best barely in the black. But over those years, the banking side of the South Sea Company's business was, in fact, reliably, modestly, and boringly profitable, which was fine, but the directors were much more ambitious than that. And the explosion in debt by the end of the decade, with the explosion in debt by the end of the decade, the company's inner circle saw their great opportunity. Next slide, please. In late 1719, working with their allies in government, who included the Chancellor of the Exchequer, which is a very nice ally to have, the company advanced a modest proposal, a swap of almost all the national debt for South Sea shares. A trial run that year on one tranche of debt provided proof of concept. And except for one key detail, the design of that smaller transaction carried over to the big event of 1720. Can I have the next slide, please? The deal was designed to be a win-win-win. The Treasury got to swap out its ungainly stew of expensive and inflexible obligations for a uniform security with reduced interest rates, from that high of 14% down to 5% immediately and to 4% in a few years by 1727. The punters got the promise of ongoing income, though less than before, as the company would presumably pass through much of its interest payments and the payments it would continue to receive from the government. And affirmatively, investors regained access to capital that had been previously locked in often illiquid debt securities, as they could now as they would be able to sell their Saucy shares whenever they wanted. And as a last benefit, they could participate in any gains that might flow from the trading monopoly side of the business, which hadn't gone away yet. And last, the company also benefited. They got a vastly expanded capital base, which both yielded income and could support its other ventures. And crucial to the events that would unfold over the next several months, it also received an enormous windfall, thanks to that asterisk in the middle of this slide. And now, Michael, I think this is time for another poll.
It is indeed. And here we go. Second poll. If you were around at the time of the Saucy Bubble, you would have made money, lost money, or stayed far away from it. I think, Tom, you're really testing our audience's self-awareness and honesty. All right.
Have a little bit of fun.
Well, over 3/4 have voted. I'll leave it open just a couple more seconds in case you're slow off the buzzers. Well over the 80% mark. Closing the poll and sharing the results. And it seems like a fairly honest audience. A fifth think they would have made money. 31% think they would have lost. And 46% would have stayed away, as they probably did from the .com and Bitcoin and some other things. Anyway, back to you, Tom.
That sounds very plausible. Okay, so I think this audience can probably guess which option was chosen for how to price the Saucy shares to be swapped. The deal, as it was finally approved, allowed the company to set its own price. The delightful arithmetic that flows from that decision couldn't be simpler. For every £1,000 of debt taken in, the company could create 10 new shares at their par value of 100 quid. But if, as they did in the first subscription, they set the stock swap price at £300, they would only have to deliver 3 1/3 shares and would retain £2,000 worth of newly created stock on the company's books. Nice work if you can get it. Next chart, please. So let's take a quick look at what happened once the deal went live in mid-April. Saucy Company shares had started to rise earlier in the year as soon as the deal became public knowledge, going from a smidge above 100 in January to about £300 as the fund commenced in April. That month, the directors both took in debt and offered shares for sale to the general public, the latter twice, at £300 in the middle of the month and £400 2 weeks later. Both of those offerings sold out. The gains for pre-deal shareholders were immediate and immense, and that group included many at court and on the order of 1/3 of the members of Parliament, whose palms had been greased earlier in the year to win approval for the scheme. The rest of the chart, again, I think speaks for itself. Shares rose to right around 1,000 in June, an almost 8-fold jump from the beginning of the year. The company sold more stock to the public in that month and again in August, not for 300 or 400 quid this time, but rather at the £1,000 peak price. Again, both subscriptions sold out. The obvious question is, why? And can I have the next slide? The Saucy Bubble, certainly in the Q&A we can talk about this at great length, but for now, the Saucy Bubble inflated through the same pressures that have recurred time and again in financial history, some combination of overt manipulation, Saucy company moves to pump the stock through as it says on the slide, through lending, through margins, through margin sales, through some layaway purchases of stock and several other moves. Actually, the most cynical was the delaying of stock transfers to keep the supply low, which was never announced to the public ahead of time. Next, there's the theme that's run through financial panics from then to now, in the use of new financial technologies by speculators, at least some of whom do not fully understand the risks involved. So recently, those left holding the GameStop bag might come to mind. Back then, it was people piling into simpler options, forward contracts, and similar devices. The common thread throughout those decisions then and running to now is a failure to understand the nature and amount of risk involved when playing with new tools that haven't got an established and well understood character. And last, there is the impact of money mania itself in its pure form, the power of a rising market to affect investors both naive and experienced, about which we're going to talk in just a moment. Next slide. But before we get to all the excitement of the mania, it is important to remember that it was possible to navigate the South Sea. Some did grasp what was happening and get out very happily indeed. That's why London has Guy's Hospital today, for example. A bookseller named Thomas Guy had owned South Sea shares since the mid-teens. He sold his entire portfolio between late April and the beginning of June, and was out well before the peak. The result was the largest honest fortune made in the bubble, and it was enough money to endow that hospital that still exists today. Most important, the bubble also saw perhaps the first rigorous attempt to apply math to stock valuation. That was the great achievement of Archibald Hutchison, the MP who is listed here as the author. And he wrote this in a series of pamphlets warning the public about the dangers within the bubble. The South Sea Company was tricky to evaluate, as the long-term impact of its trading monopoly was unknown. But Hutchison created an ingenious model to account for that uncertainty, and from as early as March of the bubble year, he argued correctly, and published for all to see, that the company was increasingly overvalued. It was possible to make sense of the market, and those with mathematical skill and the mathematical sensibilities to apply them were well placed to do so. Next slide, please. And yet, what about this guy? Of anyone alive in Europe in 1720, no one was better able to quantify expectations than Isaac Newton. Hutchison was clever, but nothing in his approach would have challenged Newton in the slightest. And Newton was himself an experienced investor, as well as the greatest mathematician in Europe, with a portfolio worth millions in 21st century currency. And yet he still lost his shirt. Not to the point of bankruptcy, but he still took a huge haircut. And here's the punchline. Up until late spring, he too seemed to have the bubble figured out. Like Thomas Guy, he'd seen that the market had leapt its banks, and he sold out his portfolio of South Sea shares acquired over the previous decade at a handsome profit. But then, unlike the bookseller, he jumped back in, buying new shares at the peak in June, and then again twice at similarly lofty prices during the summer, up to within weeks, a couple of weeks, of September's crash. And why? Not because he performed some rational calculation that just turned out to be wrong. Rather, it seems it was because he couldn't stand the thought of all that money he was losing by having sold while the market was still racing up. His re-entry was an attempt to chase a rising market. And to put it bluntly, he was, this time, the bigger fool that unscrupulous traders dream of encountering. Can I have the next slide? For Newton, read a much broader experience of the bubble as it was actually lived. I know this cartoon is hard to read, but it's one of William Hogarth's earliest satirical drawings, and I think it's one of his best. An account of the emotional drama of the bubble. If you look carefully, you can see the devil at work on the left, sort of attracting a crowd there below the little stage to worship his idol. There's a noblemen and clergymen and prostitutes alike are riding the carousel of fortune in the center with that rather evil-looking goat at its top. And in the back, on that balcony, the ladies are lining up for rich husbands. Hogarth is holding up a mirror here to his compatriots, and what they saw and we can see is ugly. All of society is vulnerable to the outsized desires, hopes, and pure greed that money manias evoke. Can I have the next slide, please? Oh, actually, no, this is the time for our next poll. Excuse me.
It is indeed, Tom, and I'm just launching it now. So, folks, having listened to this, the South Sea Bubble to you, was it an example of a rational bubble, an irrational bubble, or this question is nonsensical? And a very attentive audience, Tom. Well over half have voted in 14 seconds or whatever. I'll give it just a few more minutes here.
I hope I'm keeping the folks awake. It's at mid-afternoon, triple biorhythm low.
I've never understood if their fingers are on the buzzer because they're bored or because they're really anxious. Anyway, I'm just about to close the poll and share those results with you. Interesting there. Pretty much a three-way split.
That is interesting. I'm not sure what to make of that. All right, well, let's get back to it. That really is interesting. I have to think about that. Okay, so you know, let's turn to the question that's behind that poll. Was Hogarth right, or perhaps it shouldn't be Hogarth, it should be Newton, who bitterly complained to his niece after his market debacle that he could, quote, calculate the movements of heavenly bodies, but not the madness of the people. Was the Saucy Bubble simply a society-wide embarrassment, a moment of madness or moral failure that was not to be discussed in polite company? No. The shortest version of what the bubble, and I'm about to answer it. I'm not going to answer whether it was rational or irrational or nonsensical. I'm mostly a nonsensical person myself, and I think that before you can say the bubble was rational, you have to think anthropologically as well as economically, and pay attention to the fact that the people who lived it and who lived other experiences since report a sense of mania, of madness. And lived experience, I think, is very, very important in understanding these phenomena. But what I want to do is to see if, put the question in a somewhat different way. Was the bubble a disaster, or was the pain and craziness of 1720 actually part of something else that was rather more important and more effective in the history of the economic life of humankind? And there I answer, yeah, it really was. The shortest version of what the bubble produced was the first recognizably modern bond market, which enabled Britain to fulfill Defoe's vision of finance as its secret weapon. The crucial factor in this was the political decision made immediately after the collapse of the bubble, in which the new leader of the ruling ministry, Robert Walpole, by convention viewed as the first true prime minister of Britain, was perfectly happy to prosecute Saucy directors and a carefully chosen number of his own colleagues in government. But he refused every attempt by debt holders turned share owners to bail them out, to reverse the individual transactions that had sacrificed stable, secure, boring government securities for this wildly gyrating and ultimately money-losing stock. The point of the original deal had been to tame the national debt, to turn it into a uniform, liquid, cheaper, and redeemable instrument, bonds in effect. And the bubble had done that. Under no circumstances would Walpole let the nation slide back into old bad habits. It took several decades, but Walpole's decision played out. Even at the height of its most expensive wars in the 18th century, the Treasury was able to borrow as needed at rates that mostly stayed in the 3s and 4s. There were a couple of moments, and in the height of wartime would often, move up to the 5s and 6s. And there were a couple of moments when the borrowing really did teeter at the edge of what the city was able to support. And those the most dangerous came in the 1790s during the wars with revolutionary France, and it was a very near-run thing then. But until the very end of the Napoleonic Wars, Britain never lost the financial ability to project its power across the globe. Can I have the next slide, please? This is a depiction of what happened at 9 p.m. on June 18th of 1815. That's Field Marshal von Blücher on the left and the Duke of Wellington on the right, meeting victorious on the field of Waterloo. Their handshake marks the end of the long 18th century war between the United Kingdom and France in a decisive victory for Britain, one that was made possible, if by no means guaranteed, by the long-tail results of the Saucy Bubble. So that's a win, right? Modern finance enables modern ambitions in war and ultimately when you start lending and when you open the equity and debt markets to private companies in war and in peace. And so, if the furor over the Saucy, if that's true, then the furor over the Saucy Bubble may be just noise, a blip along the path to the emergence of the system of financial markets that, as it has grown and spread in the last 3 centuries, it has engendered the wealth of nations, if I may steal a phrase. Can I have the next slide, please? And yet, financial manias and panics have occurred over and over again in the last 3 centuries. Most recently in the run-up to the Great Recession of 2008, that's recent memory. And it's not an accident that the Great Recession's pathologies map astonishingly well to the Saucy Bubble. Extending de Tocqueville, and that highlighted bit of the quote, It's not just, quote, the temperament of the nations that triggers panics. Rather, as Newton and so many others in 1720 learned, the problem is more basic and universal. It is a fact of human nature that even the most seemingly rational among us are not reliably our own masters in the heat of a roaring market. To minimize harm, we need help. Have the next slide, please. And to me, that's the ultimate point, the reason I'm giving this talk and that I wrote this book. And to that end, I'll leave you with its last lines, which is the conclusion of a long and mostly implied argument in favor of both financial engineering and the regulation of markets in which such financial innovations are employed. Please note, I'm in favor of both financial innovation and real hard thinking and the imposition by our choice of good fences that keep those from doing the worst damage of which they are capable. So here's the quote. Thus the last lesson the Saucy Bubble teaches. At some point, ignorance cannot be an excuse anymore. Each error does not need to be made again and again. In 1720, what happened was a true experiment, something unfamiliar, as yet unexperienced. Newton and his peers may be forgiven for failing to anticipate a species of catastrophe that was brand new. We cannot claim that excuse. And with that, thank you. Questions?
And thank you, Tom, and questions of which there are many. So we've got about 12, 13 minutes to get a quick bit of discussion and reaction. And folks, I honestly, we've asked Tom to pack this in. It really is a book well worth reading and most enjoyable, full of much more detail and knowledge and thought. But let's go. Now, at the same time as this is going on in England, we have John Law in France, contemporaneous with this. And Trevor Hilder is curious, why did the French fail to make the same transition?
I do talk about that in the book. There was no time, in that rapid jaunt. There are a couple of reasons, but the most important one is that the French government, the French ministry, after their collapse with the Mississippi bubble, did the same thing as Walpole did in one regard. They actually, made the conversion stand and allowed the great French national debt, or the debts of the crown, that had been accumulated and then were, turned into Mississippi Company stock. That deal stood, but they decided that the rest of Law's system, which involved fiat paper money and taxes only to be paid in paper, it had elements that the British did not copy. And they basically said, we're going to go back to both a hard currency system and we're going to diminish the use of credit. We're not going to establish these, a bond market. We're going to go back to borrowings that are either floating and need to be continually renewed and occasionally defaulted on, or else simply, go back to using the long-term, irredeemable, high-cost loans that both Britain and France have been employing before their respective bubbles. Basically, they said, we tried this innovation and it didn't work, so we're just going to, return to our old revenue system. And it failed, and it failed quite badly in the end, and it led some very famous royal personages to lose their heads. But it wasn't, it wasn't obvious throughout the century that it would fail. There were moments throughout the 18th century when the French fiscal order was actually working reasonably well. So we can see clearly the problem in hindsight. But it's not necessarily fair to say the French were simply stupid because they had to do it.
Okay. Got an interesting question here, and you've touched on it in the sense of coming from funding wars, but Charles Vermont is curious, what is your view on the relationship between money, debt, and violence?
Oh, well, violence is a very big category. There's been a lot of really good history written on the role of the expansion in the extent and technological scale and hence expense of war in the 18th century. the 9 Years' War involved much larger armies on both sides, on the French army and the British army that was deployed, than had previously been common. William's army was significantly bigger than Charles II and James II's. And some of that continued. The scale of a ship of the line was a big piece of technology, one of the most complicated machines built in that era. And they were expensive. And the warring factions, the warring nations built a lot of them over the century. So certainly changing in the practice and scope of war created a different set of fiscal circumstances for the nations of Europe than had existed previously. And that in turn evoked a wide range across Europe. I mean, it wasn't just in Britain, of different financial investigations and experiments. I'm not sure if that answers the question, but that's what I got.
Yeah, it's a fascinating area, particularly as you get into the enforcement of debt. Yeah. Bob McDowell points out that Lord Nuffield, the industrialist, said, always leave something for others, a wise reflection when assessing market sentiment. He's also kind of curious. You touched on Perry and the thinking there, but how would you contextualize Newton's study of alchemy? He was characterized by Keynes as the last of the magicians.
That's an area of huge interest. There's a ton of really exciting and interesting work on Newton's alchemical investigations. The point I'd make is it's really difficult. It's an easy mistake to make to assess 17 to 18 things in the past by the criteria we know now. Alchemy was not. Keynes was wrong to call him the last magician. I think it shows a sort of anachronistic view. Newton was, in some ways, perhaps the first, but the greatest rational alchemist. He brought the same rigor and empiricism and measurement and observation to alchemy, and the ideas, the theory of alchemy, have been shown, I think, quite persuasively to have informed his thinking about gravity and the development of the Newtonian cosmos that we're happy to attribute to him and claim as part of his genius. So I think it's important to understand, and there were other really prominent people who were into alchemy at the time. Robert Boyle, the great chemist. There was a whole, this was not a wacky, crazy, new age crystal gazing kind of thing. This was a serious, rigorous attempt to understand something very important. How does change happen in the biological side of nature? I mean, the physics handles the non-biological, the non-living, fall of an apple or whatever. But change, an egg turns into a chicken. How does that happen? And so alchemy meant something different then than I think it evokes now.
Yeah, it's interesting. All these various scientific viewpoints. One might argue Newton fell as a victim of behavioral finance, and therefore Tversky and Kahneman might be seen to be the greater scientists and psychologists. So interesting things we could speculate on for sure. Michael Levy is curious, what was learned from the Saucy Bubble in the UK and internationally from the perspective of fraud and corruption prevention rather than the general finance? But was anything learned about the way markets should be regulated or constructed to avoid similar abuses?
I think so. One of the really interesting things, and there's been some work by much more learned historians than I on comparing immediate post-colonial America and Britain in this. Out of the bubble year, Britain really constrained stock market activity. The financial markets in Britain between 1720 and 1826 were pretty much a closed network. Only the Bubble Act, which was one of the triggers for the collapse of the bubble itself, basically restricted, who could be a joint stock company and thus who could trade in, along an exchange alley. And the debt market, the bond market that Walpole and his successors fostered, was really restricted to official borrowing. And banking was similarly constrained. The Bank of England was given an essential monopoly on English banking, though Scottish rules are somewhat different. And I believe the rule was that country banks could have no more than 6 partners, and they had to be organized as partnerships, which had a bunch of consequences to reduce the ability of the English banking system to lend. In 1783, when America got, when the United States broke away, was able to break away from the colonial power, all those rules went out the door, and you saw something really amazing. And this is kind of what de Tocqueville, I cut that quote way down, but he's really talking about the extraordinary, just constant economic activity and interest that he was observing in his travels in America in 1830. And he was correct. I mean, America's banking system was enormously more, panic-ridden and bank failure-ridden and conflicted and all that sort of stuff, but it was there. There were stock markets in multiple cities. There were a vastly greater number of corporations that were raising money on the various stock markets. And there was this unbelievably rapid leap in the United States GDP versus the prior colonies. And, to the point where it had been really a quite constrained economic zone before 1776. And it was up to something like a quarter of Great Britain's economy size by the 1820s. Still a long way to go, but this incredibly rapid ramp up the scale.
Yeah.
So I think Britain learned it could constrain risk, and America showed that constraint comes at great cost. And at the same time, as the de Tocqueville quote I put up there shows, it was already prone to repeated regional and occasionally national panics, crashes, and great pain to folks involved. With the risk, the network risk already apparent to an observer, a non-economically sophisticated observer like de Tocqueville himself. So yeah, I think people took lessons from the Saucy Bubble, and I think some of the lessons were you have to learn by failing. But we've now had a lot of experience with panics, and we can, I think, draw some conclusions.
Now, I've got time for just probably 2 questions. Charles Vermont has come back with, wondering whether the availability of debt promoted war, or was it just the response? MHC Russell was curious to remark, the legacy of the wars with France was a burden of wounded ex-servicemen and officers who were put on half pay, so making government investment elsewhere nigh on impossible during the 1830s and 40s, a possible analogy with the NHS post-COVID. But I'd like to turn to a question from Ian Harris. Do you think government's partnership with commerce over the South Sea Bubble is analogous with post-financial crises and government's partnerships with public banks? Further, do you see government's approach to post-pandemic debt leading to similar partnerships with commerce, for example, big tech or fintech? I know in the book you spend quite a bit of time explaining the deep political connections and how much politicians were pulled in deliberately into the scheme. But what could we learn today? Is there an analogy?
That's a huge and complicated question, and to answer it with to the full respect it deserves, I'd have to really think about it. But one thing, it is important to remember that the interplay between government and commerce in the emergence of early modern capitalism was intimate and ongoing, and just getting a charter meant that there was some transaction that those who were seeking a charter would have to offer offer to the government. The East India Company was primarily a trading company, and yet it routinely, to get renewals of its charters and various other maneuvers, had to lend money to the government or pay fees for the privilege and so forth and so on. And it's a considerably different sort of political economic environment than it is now. So the analogies aren't direct. But I think one thing that's clear is governments set the rules by which we and large business live. But the institutions that really affect the daily life of people in a much more profound way, most of the time, are large economic institutions. The success of the banking system, determines whether or not we keep a roof over our head. What Google and Amazon and Facebook do affects everything from our social life to our politics and so forth and so on. And given that, I think the idea that there's, that there wouldn't be an intimate interplay between government and private economic, or quasi. I mean, is Google a private economic institution the way your corner coffee shop is? I'm not sure. I think we're in a very interesting time in trying to just think in useful new ways about the institutions that have emerged over the last half century. But yeah, I think we will see, both because of the necessity in governance, but also because of just the intimate connections between power and money. It's hard to see how government and Google won't be involved in an intimate embrace in ways that are sort of, I think, supportive of a civil society in some instances, and clearly inimical to it in others. And beyond that, to think about what we should do about that is both be way above my pay grade and not something I'd like to just spout off on it at a moment's notice. I'd like to think about it more.
Kind of you to throw those thoughts in, and in some ways one could even argue that part of the result of it was the Bubble Act, which in fact impeded the formation of joint share companies for some time afterwards. So interesting.
For a full century.
Just a final one, and it's topical, and a pre-advertisement that we will be having the Newton project, which is Isaac Newton's digitized collection, appearing on a program later this year, folks. So there'll be a lot more about Newton. But you raised Newton, and you also raised Guy, and yet the Saucy Bubble was founded technically, although that's maybe not where it made its point, but technically on slavery. And we've seen Cass Business School rename itself. Perhaps Guy should rename itself. Maybe we should be taking down statues of Newton. Any thoughts, though, on how much this was a slavery company, or was this an incidental thing that got it going?
The answer is it sort of falls in two parts. It certainly did a bit of slave trading in the decade before the bubble, not very effectively. And it turns out, it's hard to sell bodies across the Atlantic. It's not just something, even the most evil of businesses have technical complexity that if you just sort of dive in, you're likely not to understand. And the Royal Africa Company dominated Britain's slave trade, certainly throughout that period. And the Saucy Bubble was not minimally involved, but not heavily involved in that time. The Saucy Company stuck around after the bubble. It stuck around as an essentially vestigial banking company for a very long time, well into the 19th century. But it also stuck around as a trading company until about the late 1730s. And the single most successful part of its trading venture, it tried a bunch of different things, but the single most part of its sort of mercantile business was trading slaves. So between the early 1720s and the early 1730s, it shipped tens of thousands of Africans to the New World. And, Thomas Guy's fortune wasn't built on that part of its trade. And in fact, the company was becoming smaller and smaller at that time. So nobody got sort of, distinctively outrageously rich through the company's slave trading period. But it's important to know that one of the arguments that investing in the South Sea Company, even during the bubble, was rational was the notion that people were placing a value on the trading side of the business that would continue after this debt for equity swap was complete. And some people have argued that the value of the slaving business was genuine and might have influenced some investors during the bubble to think that this was a good bet. That's speculative, but it's not. You can't say that's wrong.
Yeah. Tom, fascinating as ever. The clock runs out, sadly. I'd just like to thank, if I might quickly, our sponsors. I do hope that you found it very informative. I certainly did, and I even read the book. So there you go. Do purchase it. Second thing I'd like to say, if I could, is to the audience, thank you. Some very perceptive questions, and as Tom indicated, many of them too rich to fit into a 13-minute Q&A session. But a reminder that we have a number of forthcoming events, not least tomorrow morning with a fresh approach to risk management. I'm not 100% sure it would stop the South Sea Bubble, but we'll have a look at that tomorrow. And as ever, just go to the website. But Tom, thank you. We approached you cold, out of the blue. You gave us a warm and wonderful response, and you've given us a warm, wonderful, and very, very interesting and informative session today.
Thank you so much.
Unfortunately, technology doesn't allow me to give you a bunch of Saucy Bubble claps, but I have my Korean karmic clapper here, or pretend it's the old bell at Jonathan's Coffee House, and we will ring the new changes. So thank you so much for coming on board today.
Thank you. My pleasure.